I welcome Warren Shute from Financial Education for the Nation. It's Good Friday, March the 30th, so 6 days for the tax year end. Just wanted to give you an update of some of the losses, some of the allowances, and some of the benefits you can make use of before we get to the last 7 days of the tax year. So we've got until next Thursday until the tax year runs out. With the bank holiday, we've only got Tuesday, Wednesday, and Thursday next week to take advantage of this stuff. So let's make the most of it. So start from the beginning. Income, personal allowances. So 11,500 per person over the age of 13 has a personal allowance of 11,500. Make sure you're making the most of that if you're in your own company and your significant other, your partner, people get involved with this and do work. And they have a contract for employment, so it's fully legitimate. They have a personal allowance of 11,500. Now, the other end of the scale, we've got people earning over £100,000 are going to start losing that personal allowance. So if you have income from different sources, share options, remuneration, that kind of thing, it makes your income exceed £100,000. You're going to start losing your personal allowance up to about £123,000. Now, that marginal rate there is taxed effectively at 60%. Trust me on the maths, it's 40% plus 40% of the personal allowance, 60% tax on that money there. So you need to do whatever you can to reduce that money back down or as close to £100,000 as possible. One of the main things you can do, make charitable contributions or make personal pension contributions to reduce your income down to £100,000. Okay, so that's the personal allowance. Make use of it. Take action. You've got until Thursday next week, 5th of April, to do something about it. Next thing is your savings allowance. Savings allowance is the interest you accrue throughout the year. Might be a bit late in the year to do any planning around that, but basic rate taxpayers, you have £1,000. High rate taxpayers, you have £500 per person. An additional rate taxpayer, so over 150 income, you don't get anything. Okay, so sorry about that. Next one, dividend allowance. So dividend allowance is the amount you can earn tax-free from your dividend income. So this is going to be from private equity holdings or listed shares on the stock exchange, and also in your own private limited company. So you can have £5,000 for the tax year, tax-free. And remember, shareholder can be anyone over the age of 18. Okay, so if you hold shares, £5,000 tax-free. That's going down in April the 6th, April 6th, to £2,000. So let's make use of this money while we can. Let's not pay any unnecessary tax, but let's certainly pay the tax that we should be paying. For sole traders and partnerships, you can now start looking at offsetting losses, realizing any losses, making any personal capital expenditure items that can be used, and therefore they'll be attributed in the current financial year. Literally, if we wait 1 week, you're going to have to wait a whole 12 months to get the benefit of that purchase. So is there anything you need to buy, anything you need to do within your business, so sole trader and partnerships, to make use of this? Now, if you're a limited company and your company year end coincides with the financial year end, then this also applies to you. But many companies have different year end, so they don't have to straddle the financial year end. So if your company year end reflects the financial year end, so 5th of April, and if you're a sole trader or you're a partnership, then you can start looking at trading losses. So what sort of capital expenditure items do you need to do to make the most of that? Also, pension contributions. So again, same rules apply where your company tax year end is, or if you're a sole trader or a partnership. Look at making pension contributions now. Now, you're probably left it too late to set up a pension. You might be able to do it with some online platforms. You can try Lexo, they might be able to do it. But generally speaking, you've left it too late. So use your existing pension scheme, make the pension contribution. Every individual has a £40,000 limit unless their income is high. So unless they're a high earner, earning over £110,000, then it tapers down. I've done videos on that before, so I'm not going to go into the detail on that. So you've got a £40,000 limit up to 100% of your income if it's a personal contribution. So remember, individuals who may be just working part-time, but you've got some spare capital lying around. If you earn £5,000, £6,000, £7,000, we have one particular client who just earns about £7,000 part-time income, keeps her busy, she enjoys doing that. But every year she's very diligent, she ensures she pensions 100% of her income. She's getting 20% tax relief on that. So let's say, for example, you have no income, you can pension £3,600. Now, you actually only pay the net payment of that, so 2,880. That difference, 2,880 to 3,600, is tax-free. That's given to your pension free by the government, even if you don't pay tax, even if you don't have any income. Okay, so that's a fantastic thing to consider. Those pension contributions can also be done for children and newborn babies. There's no age limit going down the scale to get tax relief. So tax relief is given from anyone from a newborn baby all the way up to age 75. You can get tax relief on 2,880, gets grossed up to £3,600. So hey, this year's allowance will finish on the 5th of April, so it's gone. So if you want to use it before you lose it, and then on the 6th of April, you can repeat the pattern again. You can repeat the process as long as obviously you've got the earnings and stuff to do so. So pensions are a must, particularly if you're in that marginal band. Remember, if you're a high earner over £100,000, when you start going up to 123, you're going to be taxed at 60% on that money. So a personal pension contribution, to use that to reduce your income down, is a fantastic use of that money. If you don't have capital lying around, consider using ISAs, using your ISA money as a pension contribution. So withdrawing it from the ISA and making a pension contribution. The only thing you don't ever do is use your emergency reserve. That's number one. Always make sure you've got your emergency cash there. Anything between 3 and 12 months of money. Everything else, you've got to do your planning around it. ISAs, your ISA allowance, £20,000 for ISA. You've got your LISA allowance in there as well. That's going to run out on the 5th of April. So use it this year. You can't carry that forward to next year. Junior ISAs, so you can have an ISA for your children, £4,128. Use your junior ISAs for your children. It's a great way to sort of start funding now for future expenses. So maybe they're going to have university costs coming forward. Maybe they're going to have wedding expenses, car expense, that kind of thing. So these are things you can use for them. If you have had a successful investment experience and you might be holding some investments outside of ISAs, you might have some capital gains in there, some what we call pregnant capital gains, some unrealized capital gains. Why don't you start considering utilizing those? So selling down a sufficient amount of money to utilize your 11,300 tax-free capital gains tax allowance. There's another tax-free allowance, £11,300. You'll need to make the sale before the 5th of April, or the 5th of April, so that that money can be realized in this tax year. And you can't buy that same investment back for 30 days, otherwise the revenue deem you of never selling it at all. But you can buy back a similar investment. Or you could buy it back in an ISA or a pension. And that's called bed and ISAing or bed and pensioning. It's called bed and pensioning? Never heard of that. Bed and pension. So consider that. Selling down your investments to realize your gain, using your capital gains tax allowance, and then buying it back into an ISA or a pension or a different investment. Diversify your portfolio. Transfers between married couples or people in legal relationships, can transfer that, no capital gains tax liability. So you can transfer money between each other, and then that other individual can realise the capital gain as well. So it's potentially £22,600 that you can do that. But consider harvesting those gains and sell those gains down. Another thing you consider is harvesting your losses. So if you've got an investment that's made a loss, consider selling that, realising that loss to offset against the gain that you've realised. So the way the capital gains tax calculations work is they look at your gain, they offset your losses, and then you pay the tax on the difference. So you could say, okay, I've got a loss here, I can sell that, I can sell this gain, offset one against the other, and then look at reinvesting the money. But remember, don't buy back the investment you sold, otherwise it's deemed within 30 days, otherwise it's deemed to have never occurred. So there's some real quick video today, just running through your allowances. We're in the last rundown for the current tax year, ends on April the 5th. And then on the 6th of April, we start the brand new tax year with all the brand new allowances and stuff. So I'll do another video maybe in a week's time or so, just to get you headed up and get you to use those allowances and use those contributions that you can earlier on in the tax year, so we're not leaving it to the last minute rush. Hope this has been helpful. Please connect to me on Facebook, Twitter, LinkedIn, all the other social media platforms. Engage with me, ask me any questions, things you'd like to do. This is a result of a question I got through on Facebook. A lady was looking to make a pension contribution urgently from her company. Her company year end was December, but she didn't realize that. She thought she had to make it now, but you don't. If your company year end straddles the tax year end, which is a really nice thing to do, gives you a bit more flexibility, you have your company year period to make that contribution. So thank you for listening. My name is Warren Shute. This is Financial Education Foundation, and I look forward to speaking to you next week.